Well, let's take a look at how these geopolitical tensions are affecting the broader markets. We've got Meera Pandit, JP Morgan Asset Management Global Market Strategist. And Meera, I know you've been listening to Bob in terms of how he views oil moves, which direction oil could move in depending on what plays out. How big of a risk ultimately is this from a market perspective if we're talking about the tensions between Russia and Ukraine?
Look, markets do not like uncertainty, and this is causing a lot of uncertainty in the overall context of somewhat of a fragile market when it comes to sentiment. I think to Bob's point that one of the biggest transmission mechanisms here is within the energy market, seeing higher oil prices. In some ways, that could be more of a challenge to Europe and the European consumer than perhaps in the US, just given the Europe's reliance on Russia for energy. But equally, this could be a bit of a headwind when we think about more broadly global growth and the global consumer. So something that we're watching carefully, especially in the throes of experiencing much higher inflation on a global basis. But I think the good news is that what we do tend to see with a lot of these geopolitical conflicts is that while the consequences from a political and human life perspective are enormous, the markets tend to react during the height of uncertainty the most, and then focus back on the fundamentals. So it could be somewhat of a shorter-lived pressure on markets than perhaps the more broader consequences of the situation.
Hey, Meera, Brian Chung here. Let's shift over to the other big story for markets. Obviously, the Federal Reserve, hearing remarks from Jim Bullard from the St. Louis Fed on CNBC this morning, kind of doubling down on his view that the Fed should be more aggressive with perhaps a double interest rate increase in the next meeting in mid-March. What do you see as the uncertainty around the Fed? Because I've been watching these Fed fund futures contracts, which have been teetering over just the last 7 days or so. There was one point in time where it was like a 97% chance of that 50 basis point move. Things moving back now to about 60%. But look, markets have no idea where Fed policy is going to go this year.
That's right. It's been really a keeping up with the Joneses exercise this year in terms of predicting the number of Fed rate hikes. When we say 4, somebody else says 5, 6, 7, 50 basis points. And the Fed is preserving maximum optionality here in terms of the increments and the pace on rate hikes. We might be a little bit more in a conservative camp of closer to 4 rate hikes, just given some of the timing challenges that the Fed is up against this year, given the fact that we should see growth, inflation, and consumer demand moderate in the back half of the year. So the Fed does not want to jeopardize the health of the economy at that point. What they might do is be a little bit more aggressive up front to give them a bit of runway to slow down towards the end of the year. But ultimately, again, the Fed wants optionality here. The markets want clarity, and that's likely to lead to pockets of volatility both within the equity market and within the rates market for the rest of the year.
Meera, really quickly here, I'm wondering what all this means in terms of your portfolio or what you're advising clients. You've talked about this barbell approach. We've heard from so many guests who said, value and growth, you kind of want to balance these out. What about international allocations? I mean, is the U.S. still the best place to be, or are you starting to see some opportunities abroad?
We're somewhat more balanced in the context of the U.S. versus international. Last year was very much the year of strong U.S. growth, and that was reflected in the equity markets. This year, we're on a path to normalization, and we're facing more headwinds in light of the monetary and fiscal accommodation being removed. Whereas if we take a look globally, what we're seeing is that the durability of those recoveries didn't really stand last year, whereas we expect that to come into the play more over the course of this upcoming year. And if that is the case, we could see some pretty strong earnings there. Earnings estimates abroad look a little bit more conservative than we think could actually play out. And ultimately, the share of cyclical sectors abroad, particularly in areas like Europe and Japan, but more broadly within the emerging markets as well, is higher than what we see in the United States. Therefore, some of those areas are really levered to the economic recovery. So we could actually see quite decent performance out of international this year. And indeed, what we're seeing already so far year to date is that international stocks are outperforming the U.S., holding up a little bit better. And in areas like China and the emerging markets, actually eking out positive returns year to date.